5 reasons risk management is more important than asset allocation. You can create a compelling value proposition for your services with risk management that simply cannot occur based upon asset allocation.
This is The Rare Advisor, proud to be a part of the Advisor Advancement Network and home of a business model supercharged by recurring and repeatable events. Your host is Mike Walters, CEO of USA Financial. He is an investment advisor representative of and securities are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor.
Hey, welcome back as always, and today I want to speak to 5 reasons risk management is more important than asset allocation. So let's keep in mind, when you're a financial advisor, one of the things you have to do is you have to create a compelling value proposition, something that creates separation from you and the do-it-yourselfers, you and other financial advisors, you and robo-advisors, and right on down the list. You cannot do it. You simply cannot do it with asset allocation. Asset allocation is too easy to copy. It's too simple to do. It doesn't need a human. It doesn't need an expert. Now, you can make an argument in each one of those cases that someone who is a professional can make it better, and I will entirely agree with you on that. But the fact is, it can be done, or at least the perception is, it can be done without a financial advisor. So that alone is a quick, important jump-off point for why you need to be dealing with risk management inside of your practice to assist and help your clients. So let's go to the 5 reasons that I will address today for why risk management is more important than is asset allocation. Number 1, proper risk management helps defend against the lost decade. Allocations do not. So if you look at the lost decade, and for those of you who are unaware or are younger in the business, just go back to the financial crisis and take a look at what the stock charts look like. You'll understand very quickly what I'm talking about. But allocations do not avoid that. They may avoid it on a sliver of the pie, so to speak, but they do not avoid it on the allocation or on the investment holdings themselves. Proper risk management is going to get triggered under duress, under economic and financial duress in the markets, and it will move the assets to something of a more defensive position. So risk management can, in fact, not avoid, but help defend against the lost decade and significant market losses, which can dig a deep hole, especially for someone who's rapidly approaching retirement and they don't have time on their side to rebuild something that has a significant loss attached to it, no matter which subset of an allocation it may have applied to within their overall portfolio. Number 2, proper risk management will allow you to focus on growth in ways that allocation simply does not. Allocation is continually going to adjust over time. Generally speaking, it's going to get more defensive in its approach the older we get, and so it gets less and less focus away from the growth aspects of the portfolio, generally speaking. Whereas risk management, if you've got risk management baked into the various models and investments within the portfolio, now you don't have to allocate such large swaths to defensive measures like bonds and other things that are typically considered safer, whether it be cash, even down to money markets and things like that. You can stay more heavily invested on the growth side of things because risk management is going to help to alleviate some of that. It's going to work against, if you will, the market risks, and it's going to allow you to have, generally speaking, again, all of this has to be compliant and has to be suitable for your investor, but it allows you to, in theory, deal with smaller allocations towards defensive positions, larger allocations towards growth positions, because risk management is being applied to the growth holdings. Number 3, proper risk management can adjust your holdings based upon the current environment, whereas allocations will not. Now, I kind of just alluded to that in number 2, but think about that. Your allocations are your allocations, which in fact then are your allocations. And no matter what kind of storm you have to weather, those allocations aren't changing. Risk management can and will adjust your holdings within each of the subsets based upon the current environment that's taking place. So there will be different triggers. Again, there's many different risk management approaches you might take, or different strategists and their models that they could provide to you that have risk management baked into them. And they will have different triggering points or different mechanisms they use to handle risk management. But those holdings within that subset, within that model, within that piece of the allocation, it will in fact trigger changes and adjustments to the holdings, whereas simply allocation doesn't do those sorts of things. Number 4, proper risk management creates professional separation from financial sales pests, from call center financial planning, and from financial robo websites, because all of those other groups at best will provide asset allocation. In fact, a sales pest knows enough, even though they're just pushing product, they can create an allocation approach, depending on how they're licensed anyway. A financial planning call center can create an allocation approach. Even a robo website asks basic questions, and simply all it is, really robo investing or robo websites are really just robo allocations. That's really all they're doing. They're asking questions, they're allocating based on age and risk assessment. So risk management creates the professional separation. That's a huge advantage to having a personal relationship with a financial advisor, because they can get to know you and then they can work risk management into your portfolio in ways that, again, allocation can't do, and you generally cannot receive from sales pests, from call centers, and from websites. And then number 5, clients need financial advisors for risk management. They don't need financial advisors for passive allocation. They can do it by themselves. They can read about it. They can get access to the things I just talked about in number 4. But generally speaking, they're probably not going to be able to do proper risk management by themselves. They need a professional. They need you, the financial advisor, to walk alongside, to provide them that value that you are there to create in their life, helping them to manage their portfolios, manage their entire financial plan, and bring their financial world together and move with them through time as they approach retirement, manage or move their way into retirement, and all the significant things that occur during our lives. So again, 5 reasons risk management is more important than asset allocation. Hope that helps.
This information is for licensed financial professionals only and is not intended for use in soliciting sales from the public. The views expressed represent the opinions of the presenter or their featured guest, not necessarily those of USA Financial or its affiliated subsidiaries. Industry references are generic and not intended to represent actions or beliefs of any individual or entity. Content is only presented to illustrate general principles, beliefs, or ideas and should not be construed as legal or regulatory advice. Trademark and copyright protected. USA Financial and Affiliates.